Hey, good afternoon and welcome to today's dental webinar. My name's Jordan Dolly, partner at Jones & Roth. We're glad to have you with us today. Jones & Roth is the premier CPA and advisory firm headquartered in Oregon with over 75 years of experience providing expertise and personalized service and strategic financial guidance in a variety of specialties. We have team members focused on supporting construction, family business, healthcare, nonprofits, dental, and a variety of private companies. For our dental practice owners, we specialize in providing holistic financial solutions tailored to help dentists make informed financial decisions that support both their practice and long-term wealth building goals. With me today is fellow partner Mark Reynolds. Mark services a variety of industries and leads our retirement plan services department. Mark is an invaluable resource for our clients. He has deep expertise in strategic plan design and optimizing retirement plans to maximize financial growth. We're going to use our time today to talk to you about the different retirement plan options and how they complement the different life cycles of dental practice ownership. Our goal is to provide clear, actionable insight to help you build a retirement strategy that aligns with your personal and professional financial goals. A quick reminder, we welcome questions throughout today's session. To ask your question and get it answered, please use the questions panel in your webinar, in the GoToWebinar screen you see in front of you. The webinar will also be recorded for those that would like to share the message today with colleagues. And so with that, hey, Mark, let's get going.
All right, great. Thank you, Jordan. So we're excited to have you with us today, and hopefully it'll just give you some useful tools to know a little bit more about retirement plans, options that are available, and various features that might benefit you and your practice, depending on where you are in the life cycle of your dental practice. And so certainly we welcome your questions as we go through this. All right. Okay. All right, so just as an overview of what we'll be talking about today. So we are talking about the life cycle, where you are. We broke this up into three different components. One is the early cycle, which could be 0 to 4 years. It could be a new or startup practice. The type of plans that are typically that we're going to see in that category would be a SEP IRA or simple IRA. For a mid-cycle, it could be a practice that's established, it's been around for a little while. It could be 5 to 10 years or even up to 15 years in that category. You're looking at probably something a little bit more complicated, more features, flexibility. That would be potentially a 401k with a safe harbor plan. And then late cycle, you're a mature practice, you've been a practice for a while, potentially 15 to 20 years or more, and the owner is looking at getting close to retirement and looking at some additional things they could probably do to help them get a little bit closer over the finish line. And typically in that category, we're looking at taking that 401k and potentially adding a cash balance feature to that plan to help maximize some of those retirement benefits. So we thought it might be helpful at this stage to do just a quick poll, just to see who's here and see maybe who might be in one of these categories. And so I'll let that start. All right, looks like we got some coming in. All right. Great. All right, Sarah, I think we can probably close that. So it looks like we're at currently, at least with our group here, we have about 40% would be 15 years or more, 40% in that middle range of 5 to 15 years, and then 20% of the attendees are in that 0 to 4 category for 0 to 4 years. And so mostly mature or mid-cycle to later cycle practices. Great. All right. Thank you. All right. All right. So it's always helpful just to start out and kind of talk about why we're doing all of this. And so really having a retirement plan is to provide savings for yourself and for your employees through their working career. And part of the benefits of having this is really just to be able to put large amounts away over your working career, but also have a meaningful benefit to your employees. Often when a retirement plan is set up for any type of dental practice or medical practice, or even small business in general, the retirement plan really is geared towards the owner or the individuals that are running that organization, and then as a byproduct, we're providing meaningful benefits or contributions to your employees. But often that's the point of view and the structure that we take when we design a retirement plan for a small organization or for a practice. It's like number one is for the practice owner, number two is often for the employees, and so we structure that to benefit both groups. And then of course, one of the big ones, we set up these plans to provide current year tax savings. If you're a profitable practice, you have high cash flow, we want to be able to find a way to minimize that tax liability in the current year by deferring some of that income, getting into the plan, and help you grow and save for retirement. All right, so let's go ahead and start off with the first portion here for the SEP IRAs. And so a SEP IRA, it's basically a simplified employee pension. It's just an acronym. It is really is the basic entry-level plan that we typically see for most practices that are just starting out. It's an employer-only contribution plan. You can contribute up to 25% of compensation or $70,000 a year as a max, whichever is less. And there are limits on how much you can put in. So it's only employer contributions. There are no employee contributions that go directly into the plan. Any contributions that do go in on that percentage basis, whatever you decide, it could be 5, 10, 15%, up to a max of 25%, do go in on a pro rata basis. So that just means it's going to be the same percentage for everyone who's getting that contribution. Part of the benefits of having a SEP plan is that it can really be an after the fact plan that's set up. You may not have any plan in place, and you may have a profitable year early on, didn't really expect to have the year as profitable as you did, and you can go ahead and set this up after the fact for the prior year. So even though we're in May right now, you can still set up a SEP IRA retirement plan for 2024. As long as you file an extension for your return, you can go ahead and have that set up. You just got to make sure that it's set up and all the contributions are made by the filing of your tax return. And so it's a great, afterthought of like, what else can I do to help save some taxes for last year? Well, this might be one of those mechanisms that you'll be able to do that. All the contributions that go in are generally going to be pre-tax, and so when they come out, they're going to be taxable upon receipt when they are taken out. But a new feature that is part of the Secure Act 2.0 that just recently went into effect does allow for a Roth contribution to this plan, which is a new feature that still some of the investment providers are still figuring out, well, how do I navigate contributions going into a plan in this manner? But in theory, you could do, it's a tax deductible contribution by the business. The money can go in, it can be an actually after-tax contribution to the employee. And so what'll happen basically would mean that those dollars actually hit their account. They are taxable to the employee upon receipt. And so they would get a 1099 for that. But it is important for them to know that they would be taxable. But it does give you one more tool that's out there as far as how those contributions are actually made. Some of the other benefits of this type of plan is that it is very inexpensive, almost no cost at all to set up and get going. There's no administration costs required to have a SEP IRA plan. It can be set up after the fact, and really it is truly that simple. You can just work with your investment provider to set it up. It may require some individual accounts for each of your employees, but you can go ahead and get that set up, get it going actually pretty quickly. So it's a great entry-level place to start.
Hey, Mark, real quick, one of the things I also wanted to highlight on the SEP as a feature, right, is the employees that qualify, right? There's work requirements of them before you're required to make a contribution for them. I think that's an important thing for us to clarify, because that could be an opportunity window for some of these startup folks.
Yeah, absolutely. So with the SEP, it can really be as lenient as you want. You can have it kind of open to everybody, but the IRS does allow you to have eligibility pushed out to 21 years of age, and then at least $750 of compensation out of 3 out of the last 5 years. And so you can have it set up in a way that basically someone has to be employed with you for 3 years before they can actually be eligible to participate in the plan. And the compensation level is pretty low. It's only $750. So you could have somebody who is working on a very, very part-time basis over the last couple of years, they would be eligible to participate. But certainly if you have someone who's a new hire, they could potentially have to wait 3 years to be eligible to participate in the plan. And those are on a calendar year basis. So it could be very part-time over the last 2 or 3 years, and that would make them eligible. But you could have it as, I guess, as lenient as, you only had to have 1 year of $750 of compensation, and you come directly into the plan. So there definitely is a plan opportunity if you're trying to structure it for more of your long-term employees. All right. Anything else on that?
No, I think that was great to point out. One other kind of use case I had in recent years to that point is startup practice that kind of had accelerated growth early on. Maybe it was unexpected for them initially that for cash flow optimization, they prioritize basically solely funding the owner's SEP IRA and allowing that time frame to play out a little bit on the SEP. And they've since pivoted to another plan, but something to consider there to leverage that to the owner's greatest value.
Yeah, certainly when you first started up, you may only have just the owner or one employee that's eligible, and you could actually put in a lot more, certainly for yourself in that situation. Yep, absolutely. All right, so we'll move to the simple IRA, and simple IRA is it's the saving incentive match plan for employees. You think of this as your mini 401k. This would be kind of the next level up. This allows both employer and employee contributions to go into the plan through employee deferrals. The maximum deferral if you're under age 25 is $16,500. If you're under age 50, and then if you're age 50 or over, you are allowed to put in a catch-up contribution of $3,500. And so a new provision through Secure Act 2.0 is basically a super catch-up. And you'll see this in the 401k plan also when we get there also. But basically, your catch-up contribution can actually be, the extra, over $5,000 if your age is 60 to 63. And so they figure that you're closer to retirement, you can actually put a little bit extra in there. And it's only for those years between 60 and 63, once you're back to 64 years of age, or when you hit 64, it actually drops back down to $3,500. So it does allow you to put a little bit extra in here if you are between those ages. And also a new feature, which is kind of exciting for a lot of plans, is that it does allow Roth deferrals, which is a really new thing. We've been doing that in 401ks for many years, but finally in simple IRAs, we can now do Roth deferrals into a simple IRA plan also, which is a great way to, especially for younger employees, to be able to allow after-tax Roth contributions to the simple IRA plan. On the employer side, there's a number of different ways you can make contributions, and it's actually become a little bit more flexible. There's more variations to this with some changes in the current tax law. But the primary contribution types would be a 3% match, so it'd be 100% the first 3% that the employee does put in. That's the primary one. The second one would be 2% of eligible compensation for all employees who are eligible, whether they defer or not. We call that a non-elective contribution. So those are the kind of two primary ones. And then a new feature as part of the Secure Act 2.0 is to actually allow a higher match if you're trying to do a higher contribution limit. And so the new provision basically says you can actually put in more than that $16,500, and you can actually put in up to $18,150, so 110% of that. And then if you're going to have a higher contribution limit, you have to do a match of 4% instead of 3%. And so you could have a higher match and put in a little bit more, and it would allow you to do that, but you got to make sure that you have that higher match component also. And so that's kind of a new feature and kind of gets you more closer aligned to what an actual 401k is able to do. In addition to those contributions, a new additional contribution you can do, so if you're doing, let's say, the 3% match and you want to put a little bit extra into the simple IRA plan, you can do a new non-elective contribution. So this would just be a flat contribution up to 10% of the employee's compensation, not to exceed $5,000 during the plan year. And so this is the first time you can actually do something in addition to what you've already decided that you're doing. And so you can pick that 2% or the 3% and still be able to put in an additional profit sharing type of contribution into a simple IRA plan. And so that's kind of a great new feature there. going back to some of the Secure Act provisions, and so we do have the potential for a Roth contribution on the employer side also. Works similar to the SEP side, so it could be taxable to the employee when it's received. Important that they know that, but that potentially is another contribution type for the employee, so it could be an after-tax contribution. And again, many providers are still kind of figuring out exactly how that all works. We haven't seen that in too many plans yet, but that could be a great new feature that's out there. And then if you get this up and get it going, you said, oh, hey, I've got a kind of a down year, and I have a year where it's hard for me to get my contributions to go in, and if I have a match contribution, they do allow you a safe harbor. And so you can drop your match contribution down to less than 3, but it has to be at least 1%. And you can't do that for any more than 2 out of the last 5 years. So there's a hardship provision as far as your contributions that are required. So some of the benefits really of having that simple plan, it's really the ability to have a plan that's set up. It's not a huge commitment. It's very low cost. There's no administration or testing that's required to have a simple IRA plan. When you get to a 401k, it requires a little bit more. There's a little more complication to it. There's annual filings and some testing that has to be done. Simple doesn't require that. And so as long as you stick within the IRS provisions that the IRS specifies, it's truly that simple. There's a
Hey, Mark.
adoption. Oh, yes. You bet.
Oh, yep. So sorry, I just had one that popped up here. Is it curious what decides the actual, like what the contributions are actually invested in? You know, is there some variability to where the money actually goes to the employee's benefit and the growth of those funds themselves?
Yeah, absolutely. So with all of these plans, you're going to work with an investment advisor and get that set up at a company of your choice that would service a simple plan, and it would be invested in a specified menu or lineup that you would work with your advisor to help organize to give the employee choices. Typically for a simple, there's different variations of that. You can work with one company where everybody is invested at, which is actually much simpler. But you also have the ability to have multiple providers to invest those funds. And so there's actually quite a bit of flexibility there, but you would work with your investment advisor to help decide where that would go, and the employee gets to decide how it's invested within some specifications or a menu of investments that they are open to them to invest in. So it's pretty flexible from that standpoint.
Perfect.
Yeah, okay. Let's see, a couple other items here on the simples. There's a very simple adoption agreement. So you got just the document that organizes this. It's a one-page IRS document that says, how are we going to specify our enrollment eligibility, who's going to be eligible. You sign it, put it in your file, and your investment company may need that to get it set up on their investment platform. But it's very, very simple, and you just keep that directly there in your file. Another great feature of the simple IRA now is a new feature of auto enrollments, which more 401ks are going to that direction anyways. But on the simple IRA side, you can have auto enrollment. If you want to kind of encourage your employees to get going and get saving, you can have an auto enrollment provision directly within your plan. Yeah. Again, any contributions that go in typically are going to be pre-tax unless you're using that Roth feature, and they're going to be taxable when they're distributed, except if they do the Roth, and those would be tax-free when they're distributed. The thing about the simple IRA is that size matters as far as how big the organization is and the number of employees you have. The company can't employ any more than 100 employees. And so if you have a simple IRA in place and the company's growing and you think you might exceed 100 employees, the IRS is going to force you to actually make a change and change over directly to a 401k plan. And so as long as you're less than 100 employees, you can have a simple IRA. But if you're across that 100 employee threshold, yeah, you have to actually switch to a 401k at that point. Eligibility, the income requirement's a little bit higher than what you saw in the SEP plan, but basically you can have it as stringent as $5,000 of compensation in any 2 prior years and expect to earn at least $5,000 in the current year. So you can potentially exclude some very part-time people who've been with you for a while and they don't meet that threshold, but that is the max, is that $5,000 out of the last 2 calendar years and $5,000 in the current year. However, we do see some plans that say, you know what, I would kind of want everyone to be involved at least much sooner. And so you have the ability to make it maybe 1,000 out of the last 2 years, or 1,000 in the last year, and 1,000 in the current year. So you can be far less restrictive and kind of open it up to more if you wanted to, or you can leave it at that 5,000 threshold, which is the IRS max that they allow you to push that out to. From a plan setup standpoint, you can, of course, set up a simple IRA anytime during the year. And so if you're going to do current year contributions in the plan, it does need to be set up by October 1st of the current year. And so basically you could set up a 2025 plan from today through October 1st. It has to be set up and going by October 1st for 2025. And if you miss that October 1st deadline and it's set up after that, basically it would go into effect the first day of the following year. And so it would be a 1-1 plan in that situation. And so one other interesting feature about simple plans that have also just recently changed, there's been lots of changes out there, but basically with the change in the Secure Act 2.0, if you have a simple plan in place and you're growing and you're to the point where you think, hey, I think a 401k plan might actually start to make sense based on kind of where we're at income-wise and what contributions we can make, you can actually change from a simple to a 401k mid-year. And that's a very new feature that you're able to use. And it used to be that you had to finish out that current year and not start your 401k until the first of the following year, because the IRS had a rule that said, hey, you know what, you can't have 2 retirement plans for the same organization in the same year. So now there's an exception to that. It's the exception to that rule is directly changing from a simple to a 401k. So it gives you a lot more flexibility. If you think that you're ready sooner, you can actually make that change mid-year and not have to wait till the end of the year to start the following year to do that, which is a pretty cool new feature. All right, so those are our early cycle plans for your organization. So next we're going to hit mid-cycle. So this would be, mid-year would be 5 to 10, 15 years. You got an established practice and you've been around for a little while. So typically, if you've been around for a little while, 401k plan is where you're going to move next. And that's just going to give you a lot more flexibility. It's going to give you higher contribution limits and just really give you a lot more variables to help you maximize your retirement contributions and plan determination. So the maximum deferral amount for the 401k is $23,500 for 2025. Your catch-up contribution that you can put into the 401k is $7,500, and that's up to, or excuse me, it's age 50 and over. And then here we also have the super catch-up if you're over age 60 also. And so your catch-up contribution is actually $11,250 between ages 60 and 63. So you get to put that extra amount in there. And then again, deferrals are pre-tax or Roth after-tax Roth 401k contributions. And so you've got both of those to choose from as far as how those contributions go in for deferrals out of your own compensation. And then the new feature that's out there, I don't really call it a feature, it's kind of almost a penalty for most people, but as a 1/126, the IRS has said, you know what, if you have FICA wages over $145,000 starting 1/126, all of your catch-up contributions actually have to be after-tax Roth contributions. They basically are stating that if you're over $145,000, you can afford to pay the taxes today. You don't get to have it as a pre-tax contribution into the plan. And so unfortunately, you got to pay taxes on those today, and it's going to be after-tax contribution starting 1/126. And so I know a lot of payroll providers are getting their systems in place to actually be able to process those in that manner. It was actually delayed for 2 years until 26. So that's going to be a new one that's out there. So you might, if you already have a plan in place, you'll be hearing about that from probably your payroll provider and those that you're working with. So the next portion or important part of the 401k is really it's the contribution totals. And so for a 401k, you have what's called a maximum allocation. And a maximum allocation is how much any single individual can receive in their plan between employee contributions and employer contributions, whether it be a match or a profit sharing contribution. Total that goes in combined can't exceed $70,000 if you're under age 50. Now, but if you are over age 50, you get the catch-up contribution. You can put in up to $77,500 into your plan. And all employer contributions are going to be on a pre-tax basis. And so from a plan design standpoint, often when we're designing a plan, we're looking at, we want to get our owners contributing as close to that number as we can. And so plan design is super important to do that. And so by getting you up to that dollar amount, we're looking at discretionary contributions, which is the next section here. And so we're structured in a way that we can do either profit sharing or discretionary match contributions to help get you up to that total. Great thing about the 401k plan is that we can really structure these contributions whatever way we need to help get you to those totals. And so we can do that again, profit sharing based on percentage of compensation. We can do a flat dollar amount, or we can do just some type of additional match contribution that goes in. And so we have lots of flexibility. And with a discretionary contribution, you can change it from year to year. It's like what's going to be done, how much goes in, how it's calculated. And so there's lots of flexibility there. On the flip side, the one thing you have to keep in mind as we're looking at discretionary contributions, and we may have one or two doctor owners in a practice, and since we have to do compliance testing around discrimination requirements that the Department of Labor requires us to take a look at, because your participation from your employees may not be high enough in the plan, one thing that we want to consider is like, okay, we want to get you to that high number. Well, how can we do that? If participation isn't high enough, we may not be able to put a large contribution in there for you, or you may not be able to defer as much as you want out of your own pay because not enough employees are participating or contributing directly into the plan. And so really the next thing we start to look at is like, okay, well, how can we do that? How can we get you to that higher number? And really, it's adding an optional safe harbor feature directly to your plan. The safe harbor feature, really, the whole goal of that is to commit upfront to either a match or flat contribution for your employees that they already know that you're going to make it. And by committing to that contribution upfront and taking advantage of that safe harbor feature, it guarantees that HCEs, or highly compensated individuals, owners, are able to, at a minimum, be able to defer the max out of their own compensation. So you can hit that $23,500 or $31,000 with a catch-up contribution into the plan. It guarantees it. At a minimum, you get to do that. And so safe harbor features are pretty powerful because it gets you at least that minimum contribution that's in there, and then make sure that we can at least put that amount in there for you. The safe harbor has kind of two flavors of it. It's either a match or it's going to be a flat contribution. And so the traditional safe harbor match is a 4% match. And the way it's calculated is you contribute 100% of the first 3% that goes in, and then 50% of the next 2. So basically the employee has to put in a 5% contribution to get a 4% match. And then the other contribution type is a non-elective, where you just put in a flat contribution of 3% to everyone who is eligible to participate in the plan. And so those are the two that you would choose from. When we're starting out a new 401k plan for a practice and we're not quite sure exactly what contribution levels we're going to have, typically safe harbor match is the first place we start, especially if income and cash flow isn't really consistent yet and we're not quite sure how high a contributions. Start out with the safe harbor match. We ensure that the doctor owner can defer the max, and then we can always layer on a profit sharing on top of that. However, if we know that we're going to be able to do higher contribution levels for the doctor, often we just start you at the 3% non-elective, because believe it or not, we usually run the numbers both ways, but it's cheaper to you if we're going to try to hit that $70,000 number to do the 3% non-elective contribution. And so it's important to maybe just run the numbers both ways, see what safe harbor contribution makes the most sense. But typically, believe it or not, the 3% flat contribution offer will be cheaper with less contributions to the rank and file and more contributions to you by doing the 3% non-elective. So it's kind of an interesting twist to that. Any safe harbor contributions that go in, always want you to keep in mind that those are always 100% vested. So anything the employee puts in is always theirs, but any safe harbor contributions are always 100% theirs too. And so if you're looking for an employee retention component, now those are dollars that if they leave, they actually get to take that directly with them. And so any profit sharing dollars outside of a safe harbor contribution, you do get to have vesting on that though. And so that might be an employee retention tool you can use.
Yeah,
All
one
right.
of the things, Mark, I'd love for you to add kind of color
Yeah.
to on the vesting, right? We talk a lot about vesting and percentages, but I think it's important for us to know what does that mean? Like if someone exits service and they're not 100% vested, what happens to that money?
Yeah. So basically, a few things will happen. So if someone exits in service and there are vested dollars, of course, they get to take that with them. And so the safe harbor money or their own money they put in, they can transfer, they can roll it out and do whatever they want with it. But if they have some dollars in there that are not vested, like from a profit sharing contribution, which you can actually push out to 6 years of graded vesting, that money actually stays directly in the plan. And so that money, let's say you have an employee who's only 80% vested because they've been with you maybe 5 years or 4 years, and they aren't 100% vested, those excess dollars stay in the plan, and you can use those dollars to help fund future contributions. You can help use them to pay plan expenses. You just can't take the dollars back to the company, but you can use it for plan related items. And so it's not uncommon to have those forfeited dollars stay in the plan. And then let's say you need to make a $50,000 contribution, but you have $5,000 of forfeitures in the plan. Basically, you don't have to fund $45,000 because you can use $5,000 forfeitures to help offset that contribution cost. And so it's money that stays in the plan. You get to use it for other purposes, though.
Yeah, very helpful. Thank you.
Yeah. All right. So another kind of flavor, I guess, of safe harbor plan is it's called the qualified auto enrollment contribution arrangement. So it's a long name. We just call it short the QACA. And this is an auto enrollment safe harbor plan. As part of the Secure Act 2.0, they basically changed, the IRS did, as far as Congress took upon itself to want to encourage more employees to save for retirement. Well, how can they do that? Well, they made the auto enrollment feature required for all new plans that started after December 29th of 22. So basically a 2023 plan forward, you're required to have auto enrollment in a new 401k plan. And so looking at plan design features and what makes the most sense, since you have to have auto enrollment in any new plans, not old plans don't, but new plans, it's like, well, how can we kind of use this to benefit the practice in a way that makes a little bit more sense? And so by using this plan setup of the QACA setup, actually there's some benefits to it. And so it is still a safe harbor plan. You can do that 3% non-elective contribution, the flat contribution, just like the traditional safe harbor plan. But with the match side, you actually can have a reduced match of only 3.5%. So you match 100% of the first 1% and then 50% of the next 5%. So basically, if the employee puts in 6%, they get a 3.5% match. So you've gone from a 3.5% to a 4% match because there's an auto enrollment feature. Plus, something that's actually pretty cool is that, at least from a practice perspective, there's 2-year vesting on any safe harbor contributions. And so in this situation with a QACA safe harbor plan, you can actually have a 2-year cliff vesting period on any of those safe harbor dollars, which is it's a retention tool that's there. And so you can actually have a little bit of vesting attached on those that you wouldn't be able to get otherwise. So it is a little more complicated because there is an auto enrollment feature that you have to manage. However, the benefits of that are some reduced costs from a match perspective, and then there's some vesting that you can take advantage of. And so it's a great new feature, something that you can use to help maybe offset some of those costs of having that safe harbor plan. All right, so a few other things just to think about on the 401k side. Really it's a lot more flexible. It's a very flexible plan setup. You can choose almost any variation of eligibility criteria you want, along within certain parameters. And so the IRS says, you know what, you can have employees up to the age 21, you have to be 21 to be eligible, and you have to have a year of service, which would be 1,000 hours of service, and then semi-annual enrollment dates. And so for an organization that has a lot of turnover, the fact that you can have a 1-year eligibility actually is often a good thing, because it's really this retention tool for your long-term employees. So if you have a 1 year of service with semi-annual entry dates, it could mean potentially that an employee could wait up to 18 months to be in the plan, because if they started in, let's say, January, they meet their 1 year the following January, let's say January 15th, then they have to wait until July 1st. And so that is a long time. It's 18 months potentially to have someone in the plan, but depending on your demographics of your employees, it might make sense. For some practices, it might be, that's just too long. We want to line up with our other benefits that we're doing, and you may do maybe a 3-month or a 6-month or 9-month eligibility instead to line up with other things, and turnover isn't quite as high. But you can have really eligibility as close as, like the first day of the following month, or the day you start, or out over a year of service. And so it really has some flexibility there as to who's allowed in the plan, when they're allowed to come in and participate, and and really just kind of control those features. And so which is much different than the other SEPs and SIPLs from that context. And next part here, we kind of talked on this a little bit already, but from a vesting perspective, you have flexibility there too. For any non-safe harbor contributions that the organization puts into the plan, you can have vesting out as far as 6 years on those dollars. And so you can make it so that anything you put in the plan is 100% vested all the time, or you can make it so that the discretionary profit sharing goes out as far as 6 years, or anywhere in between. And so it really depends on what makes the most sense for you and your employee group. But having vesting on there is often a good employee retention tool. In addition to those contributions, 401ks allow for loans, which other plan types don't. They allow for hardship distributions, which can allow for the employee to take money out for various conditions that meet IRS requirements. And with the Secure Act 2.0, also there's a lot more variations of hardship distributions that are now allowed. And so it does allow for employees to have a little bit more access to their money if you want them to. These are optional provisions, and you don't have to have them. We see some plans where they don't want to have any of those extra things because it complicates the plan, and it takes money out of the plan, and it's not really there for, it's not a bank. It's there to be safe for retirement. And so that's what some employers, that's the perspective they take from that. The last item, the last bullet there, this is kind of going to be simple or similar to the SEP plan, but the Secure Act actually allows you to set up a 401k plan after year end, which is something we've never had the ability to do. So you can set up after year end. So in the following year, for employer contributions only, so for like a profit sharing contribution, after the year ends, you can't do any deferrals into it because payroll has to be done during the calendar year, but you could set up a 401k plan after the year is already over, do an employer contribution like a profit sharing contribution, and then set up and ready to go for employees to start deferring now. And so you're set up and going. And so it's a new cool feature that will allow you to get some maybe a deduction in the prior year for a profit sharing, and then you're up and going with a new 401k plan in the current year. So it's kind of a new feature there. All right, so the next area we're gonna hit on are gonna be a late cycle practices, 15 to 20 years plus, very mature practice. We're at the stage where the owner's probably starting to think about, hey, when am I gonna retire? Do I have my savings where I need it to be? I'm profitable, I have consistent cash flow, what's next? And so when you hit this stage here, the next thing you're thinking about is a cash balance plan. And so this is really for those practices and companies that are highly profitable, they've got consistent income, and they can maybe commit to making a much higher contribution from a retirement plan perspective. Also, we see these in closely held businesses or family businesses. So you've got a limited amount of owners, not a wide breadth of owners. It's really to accelerate that savings over a short period of time. In an ideal setup, we're looking at owners typically 55 to 65 years of age with a history of high compensation for a reasonable period of time, maybe 5 or 10 years or more. And then you have some employees who are at least 20 years younger. And so that's actually a pretty important piece of anytime you have a cash balance plan. You need to have that disparity between owner age and comp and other employees. You need that spread to actually get the maximum benefit from a cash balance plan. And the last key thing there at the bottom, a key bullet point, is really the owner's already, you're maximizing your 401k and you're willing to give your rank and file employees maybe some additional contributions. And if you're already maxing it out, like, this is the thing of like, what can I do next? And what additional thing can I be doing to help save on taxes and save for retirement? And this will help you save and put away more in excess of what you're already doing in the 401k. So if you're already hitting that 77.5 total, this give you that tool to put away maybe an extra $100,000 or $150,000 a year into your retirement plan by having a cash balance plan set up. All right, so what is it? So really a cash balance plan is a defined benefit plan. So think about a pension plan. And there are a lot of factors that go into it, like how old you are, how many years until retirements, what is your compensation. Those are various pieces that are really important when it comes into this context. Any employer contributions are going to be based on a flat dollar amount or percentage of compensation, and they go into a formula that's going to be specified in your plan document, and it's going to give you a required contribution each year. So one important thing to always remember about a cash balance plan or any type of pension type plan that's not a 401k is that you're committing to a contribution level for a set period of time. And so that's going to be specified in your plan document as to what that is. And so it's commitment for at least a few years. The cash balance plan really is taking that current 401k plan you have, and it's going to layer on this pension plan with it. They're going to work together to help maximize contributions that you're eligible for and really magnify it to a much higher level. So they're working in conjunction with each other. And another great benefit is it allows targeted business owners or highly compensated individuals to really save and maximize deductions, and helps you just kind of hone in on who do you want the benefit to be for and for how much. And we'll kind of talk about a little bit more about what that means. All right. So one of the key aspects of the cash balance plan is that it is a defined benefit plan, but it presents information to employees that's relatively pretty easy to understand. They know what their contribution is, and they know what they're receiving, and they get a statement annually that specifies, well, what is that benefit going to be? And so it's actually fairly easy to, from that context, to communicate. It allows larger contributions, which are great. It generally is going to benefit those owner groups. And the one great thing about it, again, is the flexibility of those design options between the different employee groups. Okay, so how does it work? Well, basically, again, it's going to be funded based on a specified level within your plan document, but you're going to be working with an actuary to determine exactly what that is. And your compensation or contributions can be determined as a factor of your compensation, maybe a certain percentage or a flat dollar amount or a combination of the two. It's not uncommon for a doctor to say, hey, you know what? I know what I can afford. I can afford maybe 30% or 40% of my compensation. And so that's what's actually in the plan document of the contribution level. And so what that does is it gives them flexibility of how much they're going to put in based on what their compensation level is for that year. And so if they're paying themselves, let's say $300,000 a year, and they got a 50% contribution level, just as an example, to make the numbers easy, you'd be contributing, $150,000. But let's say in the following year you pay yourself a lower compensation, go down to 200, your compensation or your contribution would drop to 100. And so you've got some flexibility in how much you put in based on the compensation you actually pay yourself. The other variation we often see is about dollar amount. You're committing to a certain dollar amount early on, and that's the contribution that you're going to have, because you already know how much you want to put in, you know what your compensation is, and you commit to that number. And lastly, you can do a combination of the two. One thing that's really important is that as you're making these contributions, you're going to be funding these quarterly. And so whatever your annual contributions are, they're going to go in on a quarterly basis. The only time that you can fund these plans annually, like a 401k would be if you're fully funded. And so initially, you're not going to be fully funded, and so they're going to be quarterly contributions. So you just need to keep that in mind, that they do require them more often, and you have to have the cash flow to be able to do that. And then participants are going to receive an annual statement showing their cash balance of the account, which provides an allocation and interest credits that they're going to receive. So I'll explain what that is here in a second. All right. So what your participants, and you, because you're a participant also, what you're going to receive directly in your plan is going to be a contribution allocation. Again, it's going to be that fixed dollar amount or percentage of compensation, and an interest crediting rate. And so there's two components that are going to go directly into what that contribution is. And your interest crediting rate is not the same thing as gains and losses on your investments, which we'll talk about in a second. But basically, that crediting rate is specified in your plan document of this is how much is going to be credited to each of the participants over the term of this plan being in place. And so, right now we're seeing probably 6 or 7% as a crediting rate in some of these plans. And so your employee's going to get, or you going to get that amount allocated to you plus the amount that's credited as part of that rate. And that's actually specified in your plan document. And then your actuary is going to help you determine what that minimum and maximum funding is going to be each year. So even though you've specified that it's going to be a percentage of compensation or a flat dollar amount, each of the contributions are actuarially determined. And the actuary is actually going to determine, like, okay, well, you've committed to 150, that is how much you're going to put in each year. But based on compensation and ages and demographics of everyone involved, you can actually put in this year maybe 175, or maybe there's a lower in the window, you can get away with putting in only 125. And so they'll give you a spread of a minimum and maximum that's required around the required contribution. So they're actually, while it is specified how much you're going to put in, there is a little bit of wiggle room as far as the max amount that you can put in. And so it can vary a little bit, but it is a required contribution. You're going to have to put that in. All right. So how are they invested? So the investments for a cash balance plan are managed in a pooled investment account. So it's managed at the trust level. So think of just one bucket of investments. It's managed by your investment advisor. So the investment direction for the entire plan is the responsible of really the trustee owner of the plan. So it'd be you typically see owner of the practice. They're responsible for it and working in conjunction with their investment advisor to manage those funds based on the specifications in the plan document. Yeah, don't worry that it's not directly on you. It's your investment advisor who's going to be help do this. But technically, as with a pooled account, as a owner, you are a trustee on the plan, and you're partly responsible in bearing some of the risk. And so again, we talked about this interest crediting rate earlier, and really what that interest crediting rate is, this is the specified rate of return that the plan is going to have. So the investment advisor is actually going to manage this plan directly to that and try to get as close to that specified rate as they can. Yeah. If the investments return, let's say 7% is your specified rate, and it returns 10%, well, guess what? Yeah, it returned higher, but that's actually not always a good thing. Because when it actually returns higher, what we've actually done is reduced future contributions. We've reduced future tax deductions that we may have planned on. And so that's not actually working in your favor. On the flip side, let's say the investments don't do as well as they're intended, what may require higher contributions in the future that you hadn't planned on to cover any shortfall within the plan. And so the IRS and Department of Labor has a plan of how you can actually help fix that. There's a mitigation plan to help fix any shortfalls, but you may have to put in extra money that you hadn't planned on. So I think really it's keep in mind that the investments in a cash balance plan are not a 401k. We're not swinging for the fences. We're not trying to make the returns as high as we can. We want them to return what we had planned on them returning, because otherwise it may have a negative effect in the long run. It's important to work with an advisor who has experience in working with cash balance plans, because there are Department of Labor requirements around how the assets are invested and all the specifications, making sure that we're doing things according to your plan document. So it's important to just really understand how it works and any of the additional requirements to managing those funds. And really the goal is to just manage the investments based on what your plan crediting rate is and get as close to that as you can. Nothing's ever perfect, but you always want it close. All right, so a cash balance plan is intended to be a permanent plan. And so what permanent means is, it's a little bit vague by the IRS, but typically it means at least 3 to 5 years. If you're gonna have a plan for a shorter period of time, the IRS could actually disqualify it. They may see it as a tax avoidance scheme, but I've never seen one disqualified, but in theory that could happen. When it becomes time to terminate a plan, typically it can take at least a year to wind it down. 401k you can actually close down and probably pay out within a couple months. But within the cash balance plan, plan on at least a year, because we have to do the final evaluation, we have to get final contributions in, so it can take a little bit of time. You can make changes to a cash balance plan, but you got to do it sparingly. Just be really thoughtful about what those contributions you want to do, how you might affect the employees and different employee groups. So you just want to be really thoughtful on the initial planning up front of how that's actually determined. And then when it is closed down and dollars are rolled out, it just works like any other retirement plan. You can actually roll directly into an IRA or another 401k. And so it's actually similar to a 401k in that regard. Let's see here. There we go. All right, so I think we've hit on some of these here. We're getting short on time. So again, we want to make sure everything's managed according to what we specified. You got quarterly funding. We just want to keep that in mind. And then we don't want to fund any higher than we than we plan on, because that might actually work against us in our plan. And the last item I just want to hit on here, this last bullet here, is like higher contributions for rank and file employees. For younger owners, you may have a lot higher contributions. So if you have a young owner who wants to do a contribution or have a high contribution for themselves, and you have employees of the same age, you may have to put a lot of money into the plan. And so it may not make sense, but it may be worth looking at. Maybe this isn't the period or time yet to do a cash balance plan, but age is important, and that spread of ages between owners and employees. Okay. When it comes down to the cash balance plan, it's really just deciding what are your goals, who's going to be involved. Really just take a survey of any of the other owners. Some may want to be involved, some may not want to be involved. Just really understand, well, what are your goals and at what level do they want to contribute. Some owners may say, you know what, I'd rather have the cash. I may have student loans I want to pay down. I want my money to go there, but you can contribute to this if you want to. And so that might be really who it's structured for. Keep in mind that it is a whole nother plan, and there is administration and there is actuarial work required. There's testing and the 5500 preparation. So if you have a 401k, it's going to be that times 2, because there are 2 plans, and got to have a plan document that organizes all of these items. And then typically what we see for most plans, you're looking at cost annually between $5,000 and $8,000 in administration. That can vary a little bit depending on the size of the plan, number of the employees, but there is some additional cost to doing it. But if we could put away another $150,000 a year for you, the cost is actually pretty low. And so it's just something you just kind of have to weigh, that there is additional cost and compliance requirements around it. One other item I want to hit on here as we're getting close to the end is we have a chart. It's on our website. It's in the section for retirement plan services and retirement resources. Just a really easy tool to just kind of compares all of the different plan types, cost and complexity, going from left to the right, just to kind of give you a resource. And we have this updated for 2025, and so it kind of gives you a good resource to just kind of weigh the different types of plan types that you might be looking at. All right, so we're getting close to our time here. I wanted to leave a few minutes for any questions. Jordan, do we have any questions that are there?
Mark, well, I'll just transition to that point while we wait for any kind of final questions to trickle through. Impeccable job, as always, Mark, going through such detailed information in a nuanced, interesting way. One of the things I wanted to point out, we current attendees and those who will listen on the recording, you probably heard Mark mention the Secure Act 2.0, I don't know, anywhere between 10 to 15, maybe 20 times. And the reason for that is that was a widespread act, right? It changed over 90 there's over 90 changes to retirement plan and tax law in that act. So kudos to you for touching on some of those important updates as far as that goes. And then while we wait, there's one thing I wanted to have you assist in making clear to folks. You had mentioned in the cash balance plan component, the financial advisor, again, you mentioned it on the SEP and the simple. Why is it so important to have a financial advisor assist in deciding suitable investment options, for the plan sponsor? What is that risk advantage from that standpoint?
Yeah, well, I think majority of the risk comes to that as the owner or trustee of any type of retirement plan. Really, you're a fiduciary to your employees, and it's important that things are being run and you're working with somebody who really understands retirement plans. There are a lot of great advisors that are out there, and some work in retirement plan areas and some don't, but really understand, well, what are the compliance requirements around that? What does the Department of Labor want to see as far as education and suitable investment options for your employees, and then being sure that's being run in a responsible manner. And it's just important to, whoever you work with, just make sure that they understand what they're doing and fulfilling that fiduciary duty that is required to ensure that not only your employees are getting the most out of it, but you are too, but you're doing it in a way that's very in a responsible manner. So.
Yeah. Good point. Well done. So yeah, I'm waiting for fresh questions. I'm not seeing any new ones trickle in. Could be this the lunch hour and folks are need to get back to filling and drilling. So we're certainly eager and open to entertaining any conversation you want to follow up our presentation today, whether you want us to review plan design and see, hey, maybe you're leaving opportunities on the table, or what amendments should you consider to be further advantaged. Happy to have conversations in that realm, or if you're a dental practice owner and would just like to have a further conversation with us, please reach out. We're happy to help in any way we can. Mark, any final comments you want to share with the group?
No, I other than I really just feel like having a retirement plan for your practice is just going to help not only you save for retirement, but it's going to help your employees. It's going to improve retention for those employees, and it's going to set everybody else on a better footing. I mean, so many employees themselves don't have retirement put away. They don't have retirement savings. And not only is this going to help you get where you want to go, but it's going to really help your employees also and help get them towards having some retirement savings set aside for themselves. And so I think there's multifaceted benefit to not only you and your practice and getting you to that over the finish line so you can retire, but it helps your employees too.
Appreciate that. That's great, Mark. All right, folks. Well, hey, thanks again for joining our webinar. Happy to be a resource for you, and look forward to further engagement in the future. Thank you so much.